And we are live, and ladies and gentlemen, welcome. I am live. I'm here with Joshua Scigala, one of the original true OGs of Bitcoin, and we have been bouncing off each other for, I don't know, 4 months. I mean, we talked for like an hour one night. We fell in love, and it was this bromance. And then he's like, "When the hell are we? When am I coming on again?" And I'm talking to his people, and we're just bouncing. We finally made it happen. We're here, Josh.
Yeah, we're here. We did it. Thank God. It's been far too long. Yeah, how have you been?
I've been good, man. I've been busy. I don't have everything going on you do, I'm sure, but it's definitely been interesting as things start to heat up in the market. So when we talked before, we were talking about the standard, and I thought this was one of the coolest damn things I've heard in forever. And but before we even go into that, I really want to kind of get into your beginnings, man, because you have a story you really don't hear that often. And if you do hear a story a little bit like yours, it's some douchebag that like made billions of dollars and then they're just out flaunting their Lambos and, you know, trying to build an Instagram account. Like I don't know. You never really know what's real, but you have a very legitimate background in Bitcoin since 2011.
Yeah, something like something like that. Yeah, 11. Yeah, I think so. Yep. 10, 11, somewhere around there.
Early.
Yeah.
Very early.
Yeah.
So what happened?
I don't have the hair to prove it. Well, look, I built the world's first swap site where people could swap clothes back and forth because after 9/11, this is going way back. You know, it's like the Goonies. Start from the beginning. Okay, I was born, and back in 2011, I started wondering why that happened. What's the deal there? And it basically came down to follow the money. And when I followed the money on that, I started really seeing just a corrupt system built corruptly. Not that there's corrupt people, which there is involved there, but just math, like a computer program can be corrupt by just writing the wrong code. So so the banking system, using fractional reserve, printing money out of nowhere, all of this kind of stuff is just awful. So we something just playing for some reason.
Is everything okay?
Yeah, just I've got someone that arrived to do and then I've now got something playing in the background. Sorry. There, when you got a million tabs open and something starts playing.
I do. I get it.
Yeah. And now something else. All right, now I'm back. Okay, so
while you're figuring that out, I'll ask the chat if my audio is okay. I want to make sure that everything's loud and proud for everybody listening and watching out there.
Can you just hold the phone for a second, because I've got to just quickly start. Someone's just arrived, so I've just
that's fine.
Yeah.
It's the IRS. Go take care of that.
Yeah.
Well, okay, so far so good. Every audio is great. Good. All right. I just wanted to make sure. I mean, just this little backstory to this interview. He has an assistant that reached out to me a while back, and he basically said, "Hey, are you familiar with Josh Scigala?" And I was like, I don't know who it is. And he gave me a little bit of a backstory, and we had a private Zoom chat where we talked for probably an hour. His background and how he got started and what he's done since then. And he's very much just kind of anti-corruption, anti-machine. And he's very much in favor of, Bitcoin and what Bitcoin meant. And it's what got him onto Bitcoin very early on, 2010, 2011. I mean, I don't know many people who got into Bitcoin around that time. So it was obviously the goal, the mission of Bitcoin and the decentralized nature of it. And he was smart enough to get in back then, and he's been building systems to basically empower people and working on very big projects and things. So yeah, I'm actually excited to have him on, because we've been bouncing off each other forever. I mean, for months. It's been probably 4 months at least. So yeah, I'm definitely, and I'm like, we're gonna make it happen. We're gonna make it happen. And then we had it all scheduled to one day, and we schedule this stuff so far in advance. And I always tell everybody, scheduling stuff in advance for me is really difficult, because I never know what's going on from day to day half the time. And turns out it was scheduled literally on Thanksgiving dinner. And I'm like, this doesn't work. He's an Aussie. He's out in Australia, I'm pretty sure. So the time zones are wonky, and like, it's probably the butt crack of dawn for him. I'm guessing he probably woke up really early, and it's like, later in the afternoon for me. So I guess while we're waiting, just let me know if you guys have any questions in the chat, and I'll answer some questions. I think he's coming back. All right, here we go.
All right, I'm very sorry about that, guys.
You paid your taxes, and you're back to the live stream.
Yeah, I'm back to the live stream. So I in the beginning, I wanted to basically follow the money, and so I built a swap site rather than using money. People could swap, and then I found really early, like, man, swapping sucks, because, man, I really love your t-shirt there. It's fantastic. Is there anything I have that you want? And you go, no, not really. And then that deal falls through, and that's horrible. When there's a whole marketplace, let's say we're in a marketplace like eBay, I could give you a credit or a something, and then I could have your top, and then you could find something else, right? This was mainly for women. We built it because women love clothes, and they
so you're trying to get women's tops on the internet. I understand. I know
exactly.
You're going so far.
Super sketchy. Super sketchy.
Hey, how about some Bitcoin?
Exactly. Well, this is far before Bitcoin. This was the world's first site where people could swap pretty much. And so
it's like a flea market, like a digital flea market kind of thing.
Yeah, digital. eBay was around, but it was primarily for swapping. There was no money involved.
Okay.
Because I thought I'd love to build an alternative economy. And then I realized swapping sucks. So I started to look for a way to do digital money, or a credit, or a token wasn't the word we were using back then, but and I couldn't do it. And then I started searching around. I did find the Cypherpunk mailing list and what they were trying to achieve. I found what eMoney was doing, and some of the eGold and things like that. And it wasn't quite right, because there you were still a central bank. You're still dealing with a central bank, and that's just we're basically going full circle. So I gave up on the idea because of that digital money without a central authority, because the cypherpunks were saying it's an unsolvable mathematical problem or computer science problem. But I kept my ear to the railroad, so to speak, kept on looking out for stuff over the years afterwards. And then all of a sudden, Satoshi's white paper hit me in 2010, late 2010, I think. Yeah, late 2010. And I was like, man, they've solved it. This is it. This is the thing. And I've got a video of me in 2011 saying Bitcoin is not a scam. And try to fight it. Back then, YouTube, you could answer people with another YouTube video,
right,
posted under there, and so I was like, Bitcoin's not a scam, it's perfect. And I even said, like, Facebook's going to bring out their token one day, and and then years later, Facebook wanted to launch a token. But yeah, that was kind of my origin story. And I wish I'd bought more, because back then it was just some weird thing and then Silk Road got built and stuff. I basically, I've held and lost millions, if not billions, over the over the years. But it was basically Mt. Gox then happened, which was the very first Bitcoin exchange to launch, and
it was originally for like Magic the Gathering cards, right? And it kind of morphed.
That's right. It was also a swap site, basically, like SwapStyle was. It morphed from trading Magic the Gathering cards, and then got sold to Mark Karpeles, and he went on to then, I don't think he was a corrupt guy. I think he just didn't know what he was doing. He was.
But did anybody then? Really?
No
Like, how many people really knew what they were doing back then? Yeah.
No one, no one, no one. It was really just people trying wacky stuff, specifically digital. We had no idea about digital security back then. You know, we've got thousands of years of understanding how to lock up gold and silver. We know what we're doing there as a species. Even there, you get the Ocean's 12 team sometimes being able to hack into that stuff. But basically, digital security was this brand new thing. No one really knew what to do, and still don't. Like, we're still seeing enormous hacks happening in the DeFi space. So
Right.
yeah, and so I lost a lot of money in that, and that caused me to build a transparency protocol called the Glassbox protocol to make exchanges more transparent. Because I feel that if the crowd could have told Mark Karpellis, hey, something's not adding up with these numbers a bit earlier, we could have, saved a lot of people a lot of money. And so I built this protocol called Glassbox protocol and shipped it around, or shopped it around, to a bunch of early Bitcoin exchanges back then. No one wanted to touch it. Like BTCE, couldn't even get in touch with. Bitstamp didn't want it. Like, there was but like, I'm not calling out Bitstamp here, but just the early exchanges, there wasn't that many of them, and
Poloniex,
no
I
one
thought,
wanted
was one of the big original
Poloniex.
ones. Mhm.
Yep, Poloniex. And then I thought, well, it's probably because they're all in fractional reserve, and and so then I thought, hey, uh, let's build our own exchange, but rather than using fiat, let's build a Bitcoin physical gold exchange where people trade Bitcoin, and because back then, your bank account would be shut down if you withdrew any gains and it came from a Bitcoin exchange, because all of the headlines were drugs, everything bad. Because that's the clickbait titles
Right.
that people were after. They weren't like, Satoshi invents new, human saving, freedom loving currency that's going to save humanity from the CBDCs. No, it was like child porn and all the worst headlines you can think is all bought with Bitcoin, and so
It was
yeah, your
similar to
bank
like
account.
UFC, like Ultimate Fighting, MMA back in the day. The only headlines you ever saw
Yeah,
were negative. It's cockfighting, it's barbaric, it's terrible. You know what I mean? And it's just like,
yeah,
I feel like everything always starts as some sort of political ploy. When something
yeah,
new hits the masses, and then you've got all these people that want to take a stand against it, because otherwise, what else are they going to stand for? And so they just come up
yeah.
with all of the negative ways to paint something that they don't understand. And that's really what
Mm.
ignorance is such. Yeah, I totally get what you're saying, and I feel like we've seen that
Yeah.
time and time again. And anytime there's something brand new,
Yeah, man. Totally. So, yeah, and then so we created the Bitcoin physical gold exchange called Voltor in 2014. We built it, launched very early 2015, and yeah, that was amazing, because it was a way to basically take profits off the table without using the banks. You could just trade into physical gold using an order book. The gold was allocated in your name, so it was off of our books. So if we went bankrupt as an exchange, liquidators couldn't touch our clients' assets, because the gold is not in our possession. Sorry, we're looking after it. We're a custodian of it in Switzerland, in a Swiss vaulting facility, but it was audited by BDO, and insured by like Lloyd's. So this was a really good way of saying, hey, we can start pricing Bitcoin in gold rather than fiat, because everyone's talking like obsessed with the US dollar value of Bitcoin, and we all got into Bitcoin to get away from the fiat US
exactly.
dollar.
You're right.
Yeah, and I was like, but why are we pricing this thing every time in let's price it in let's price sats in gold anyway. So
Well, and I
yeah,
think a part of
that's
that too, though, is that everybody's speculating to try and improve their current financial position, right? Not necessarily. It's a utility tool for speculators, really, because until there's
yeah,
true mass use case, until I can go out and easily, I've actually bought a vehicle with crypto before, right?
yeah, nice,
And when we moved to Florida, first thing we did is we bought a car, and I bought it with Ethereum, and
Nice.
and they had the systems and stuff to do that. So, but until like we're seeing massive use cases to where we're easily able to get in and out utilizing crypto for various things, it's all about money. It's all about the fiat still. So, and it's still, because it's all such a baby. It's all still an infant, man. And I feel like it's just now starting to learn how to walk. And until it's really running, that is kind of the thing, especially for all the newcomers. The newcomers know dollars. They don't know sats. They don't think of any value in sats. So that's just kind of a whole part of it. But I totally get what you're saying. Now I'm looking
it's hard enough. It's hard enough. Oh, sorry.
Go ahead. Oh no, I was going to say,
I was just going to say,
this is an Australian thing. You're getting my signal like 5 seconds after. Yeah. So I've got your website pulled up for the standard.io. And I want to let everybody know this is not a paid segment. Josh has not paid me anything for this interview. This is not paid. He's here because after talking to him privately for like an hour and getting an understanding as to what he's building, what he's doing, I just thought this was very well worth bringing him on to discuss, and something that I ultimately thought would be really cool to get involved with at some point personally. But I have a lot of questions about the standard. But first, I want to ask you, I used to be a big fan of Alex Mashinsky. I thought, here's a guy, he has, the TCP/IP patent. He's a whale. He's like, he's somebody who has he's not worried at all about challenging the systems that he believed are really failing people, really profiting off of the ways they can, just throw fees on people, and just the whole gambit, right? And I really thought he was genuine in his mission to achieve so many different things. And I was a big proponent of Celsius, and I thought, he's really doing something that I think ultimately is going to be the way that people deal in loans. And I almost took a big loan against what I was holding at a time when we were moving to buy a house. And I thought, why not use my assets, borrow against it, buy the house, pay that back at the height of the market, yada, yada, yada. Right. I'm glad I didn't, obviously, in hindsight. But I'll tell you, like, I do have questions in terms of like, how does the standard, what similarities are there? And then what sort of things are in place to make sure that something like that couldn't happen again? Let's say you get hit by a car and your noodle gets knocked loose and you decide to pull an Alex Mashinsky, right? Like, what is there to stop that from happening? How are you able to build trust with a public that was recently burned by something like Celsius? Because talking to you, I felt like you were and I remember our conversation, and I felt very much like you seem to be wired very much like me, where it's like, this isn't necessarily about making a shit ton of money on the backs of people. You're just trying to create something that you believe in technologically, and something that will ultimately benefit everyone. And Alex was very much all about the money, right? And now in hindsight, I can look and watch old videos and interviews, and I could see little things that maybe should have clued me in. So, and there's not necessarily anything wrong with that as long as everyone benefits from that mentality, right? And we learned, obviously, that wasn't the case. So in looking at the standard, I guess we can start by kind of going into what is it exactly, and then we'll dive into some of the other little micro questions as it relates to like what's happened in the past and how standard might be different.
Yeah. So fundamentally, the problem with crypto is that, Satoshi created this amazing thing called Bitcoin, and we went from using centralized banking to, hey, we can use decentralized money. But then all these centralized things came along. Celsius paraded around because it had a token as a decentralized system, but it wasn't. Basically, you locked your funds up, and then they had access to it and invested in it.
Right.
And basically made it a fractional reserve system, and then also it invested badly because they invested in illiquid assets, as far as I know. So the thing is that we went basically a different route. We went, okay, not your keys, not your crypto. I don't want to hold people's private keys. I want people to lock up their ERC20s or their, wrap Bitcoin or Ethereum or Link or ARB, Pax Gold into a smart contract that they control. We don't have access to it. So you send money into a smart contract, you lock it. Now that money is now locked, and then you borrow against that value. And you can borrow against that value by minting brand new stablecoin. Basically, it's a decentral bank. So a central bank just mints currency as debt. Well, now you mint currency as debt. So Maker DAO started this idea of a CDP where you can lock up Ethereum and mint DAI. The problem is that you have no control once you've locked up assets. So we're really focused on the borrower. We didn't want an interest rate. We thought interest is, at the base level. Interest is okay. If I lend you money, then interest is good because I've got opportunity cost and you're paying me for that opportunity cost, meaning I could have done something else with that money, but instead I lent it to you. Mm-hmm. But if at the base level of money there's interest, that's just, again, a corrupt system, a badly designed system that just leads to like a game of musical chairs where there's not enough money in the system than there's more debt than money. Just like musical chairs, there's more people than chairs. Mm-hmm. And someone's going to fall down. So building a system where you have 0% interest and 110% collateral is a really nice sort of sweet spot. In the meantime, since we've architected, there has been another protocol that came with a similar thing called Liquidity, but they've got also different problems. So the second problem is, okay, once you've locked assets and you've borrowed against them, those locked assets are just stuck there in all these different protocols. Why can I not have the ability to trade that value to something else? So let's say I've got a whole bunch of ETH locked up in my smart contract. I've borrowed against it. I've bought my house, my car, whatever it is, and the market's crashing. It's just red. It's just blood in the streets. And you're like, oh man, it's getting close to that 110% collateral ratio. What am I going to do? Well, in the standard, you can take your collateral and swap it to something like Pax Gold. Now, gold is great because it's still a bearer-based asset, except it's tokenized, so it doesn't follow the price of Bitcoin. Like there's not much diversification in the crypto landscape. If Ethereum's tanking, Bitcoin's tanking, and everything's tanking. If Bitcoin's tanking, Ethereum's tanking, everything's tanking.
Right.
So the smaller cap ones, if they tank, it doesn't touch Ethereum. But generally, if Ethereum or Bitcoin tank, the whole market's red. You can see, everyone's seen coin market cap on some days. It's just all red.
Oh yeah.
Or all green. So diversification isn't a thing. But if you use something like Pax Gold or any other sort of gold token, the thing is gold tokens, you've got to be careful because there's a lot of scammers out there. So that's why we went with Pax. So it's a great way to basically protect your holding and not get liquidated. And then in a bull market, you can say, hey, I want to trade some of that Pax Gold into Link or something that I feel has more potential in the bull market. So that's one thing. The other thing we wanted to focus was, I wonder if we can structure these collateralized debt positions as NFTs, dynamic NFTs. So we built these new types of NFTs called dynamic NFTs. We're really trailblazing this. And people, basically what a dynamic NFT is it's an SVG file, which is an image file, but we can actually in real time insert data into that image file. So what we do is we query the blockchain and we put how much debt is in the image, what assets make up that debt, and how much collateral is in that debt, and how much debt has been taken out against it. So if you pull up somebody's vault, their NFT will show how much collateral's in there and how much debt's taken out against it. And if I can now sell that debt.
I was going to say, can you sell the debt? You have people buying up other people's debt for holy shit. Yeah. So, and you get that collateral as well. So if you buy, if someone really needs liquidity fast, and they've lost their job, they can't pay off their debt,
hey, I've got all this money locked up there. I'll just sell it, and someone will buy that debt and collateral off of me. And it's a really nice way. You can also use it to just send somebody. I had this case the other day. I thought maybe one of my seeds was compromised. So one of my seed phrases. So I thought, I might just move my vaults. And then I had loans on Liquidity, on Maker, because I was doing all this testing. I was like, man, I had to pay off all this debt at a massive loss because Ethereum had tanked since I took them out. And so I had to pay them off. I had to pull the collateral out. I had to move it to a new seed. I had to reissue. And with the standard, I just went over and selected all my NFTs, which represented like 20 different vaults. And I just sent them to a new address. And they just disappeared and reappeared in my new address. So I didn't have to close any positions. It was just fantastic. So this is basically what the standard is and what we've built. And it's all non-custodial. We have no access to this collateral.
This is kind of mind-blowing in a way. So let's just, here's the thing about this. This is what's so funny, is I almost feel like the idea is so pure, like it's so legitimately pure that like, who's going to shut it down? Like somebody will want to shut this down. Does that make sense? Because like if it can't be controlled, everybody's basically maintaining their own assets even within the system, and it's just almost like too empowering for people. Like, what happens? So let's say you've got 5 Bitcoin, you want to borrow against it. What's the borrow to collateral ratio? You said it was dropped down to 110%. What is the collateralized ratio of doing a loan? And then what happens if you don't pay it back? It's just your assets are then locked up until it's paid back. And then how does the protocol generate any revenue?
Yeah, so there's a 0.5% fee at the front when you borrow. So that mints as debt. So it's kind of like a fee that you don't even really feel, because it just mints a little bit of extra debt. And then when you pay it back, it's another 0.5%. So it's a 1% round trip from borrowing to paying back. There's no time limit to pay it back. So if you borrow and you've locked up 5 Bitcoin and you've borrowed against it and bought a house, there's no time limit and there's no interest. So you can take forever, or you can lose it and never pay it back. The thing is, there's more value. There's 110% minimum that you've locked up. I wouldn't recommend going up to that, because if there's a little fluctuation in the price, you could get liquidated.
It's okay.
Yeah, but you could borrow right up to it and then switch it over to something like Pax Gold, which doesn't move, 10% a day because it's gold. It's still volatile compared to.
So you would do that because in one case you could say, all right, well, let's say I have whatever, 1,000 at Cardano potentially, and then let's say I wanted to borrow half of my current asset value in Cardano to buy more Cardano. So now I've got my asset in lockup for the loan. I've got another 50% of those assets that I've basically then used to accumulate more. I'm paying 0.5% up front to activate the loan, another 0.5% to close out the loan. So I paid 1% on the 50% of my total assets. But then in some cases, if it's based off the fiat value of the loan, right? So if I effectively wanted, if I did the loan with Cardano at 30 cents and it goes up to 50%, I could potentially pay the loan back another half a point using the increased value of my in-stored assets. Is that right? So, and that's if I'm in a bull market, I can basically let the value of what I already hold pay off the value of what I just took out. And if I didn't want to deal with that, maybe if I thought the market it was close to a peak, I could say, instead of maintaining the value of what's locked up, I then convert that into the PAX stable token so that I'm not having to suffer should the price peak out and start dropping under my nose. I'm not really aware. Is that what you're saying? That kind of how it all works?
That's right. And the thing is that you have currently we're a very new protocol, right? So where basically we need more liquidity to be put into the liquidity pools because we don't have we're just a super young protocol. So we've built a bunch of incentives to get people to put USDC into the stable pools on Camelot decks. So we need right now people to come along. Actually, by the way, TST, which is the membership token, it drops. It gets a share of all the fees that people pay. That 0.5% gets dropped onto TST stakers, and we're launching that very soon. Plus, there's a liquidation pool, so people can stake EUROS and TST, which is the stablecoin, and TST, which is the government token, into a liquidation pool. And whenever there's a liquidation, it basically drops down into that liquidation pool, which means that anybody can buy those assets that are getting liquidated. So if there's Wrap Bitcoin and Arbitrum, Arb in there, and some Link, you'll automatically buy that stuff at 10% under spot because it has to be over 110% collateralized.
Holy shit. Okay. Wow.
So that's rolling out in about a week and a half, that liquidation pool. And here's the other cool thing: to stop the depeg of any of these stable assets, we're building a function that enables you to borrow from yourself. Let's say in this scenario where you're buying the house, and have 0%. If the EUROS drops below the euro, you can set a flag to say, hey, pay off my debt automatically by selling some of my collateral to pay back my debt at a discount. So let's say EUROS drops by 10%, it's like at 90 cents to the euro. So the pegs, you can pay off your own debt at the face value of EUROS, which is 1. So you can go in there and sell some of your, basically buy up EUROS automatically, which does two things. It lifts the peg back up, but it also pays your debt off at a discount.
So I'm seeing some of the comments. So cast the dock. No, that's the beauty of what I'm hearing here, and that's kind of the beauty of what I'm seeing with the standard and everything. Joshua isn't able to control or even touch your assets. Celsius Network could. They could take your investment and say, I'm going to borrow money against myself. Here's my collateral. And then Alex can take that and go buy a mining farm. That's the difference. This is completely DeFi protocol driven, right? And is there any way? Is there any single person? Because it doesn't sound like you're not necessarily getting rich off of this. It doesn't sound like this is set up in any way where you've got like a wallet where like money's getting pumped in every month after, how does this generate money for anybody, or is it not set up to do that? I don't understand how, what is the, outside of just giving everybody an opportunity to make loans and kind of have this, it almost feels like a semi-autonomous system based off of the liquidity provided by people. Is there anybody that, if you had $30 trillion in liquidity on this system, do you make money, or is it not set up for that?
So TST holders, which is the standard token, every single loan, and we're starting with EUROS, but we'll be launching USD-S soon, Indian Rupee S, British Pound S, Aussie Dollar S, basically the entire FX market, as different stable coins, stable assets. And every loan that's taken out and borrowing one of these stable assets is paying that 0.5% fee, which gets dropped onto people that are holding TST in these contracts. And they have to do a little bit of work, so it's not a security for that, but it is what it is. And we work really hard to make something that's good. So there's no lender, and there's just borrowers. You're just borrowing money from yourself because you're minting new, fresh stablecoin. No one's lending it into the platform. Like Celsius, had to charge an interest rate because there's lenders. And then not only that, they were centralized.
Because they were connecting people.
Yeah. Yeah. Yeah, and you also BlockFi, same thing. Like, just awful systems
Okay,
using
so now,
centralized
okay,
nonsense.
you saying that clicks. That's another thing. I'm slow. I'm not as smart as you, Josh. That things take me a minute sometimes to click through.
All good, man. All good.
So,
No,
yeah,
that's right.
no, that makes
It
total
definitely.
sense.
Yeah, I'm definitely not smart especially at 7:30 in the morning.
Yeah, well, yeah, you're almost exactly 12 hours, but I mean it's almost 5 here. So yeah. How does this DeFi protocol survive if liquidity pool numbers dwindle in a bear market when everyone pulls their money out of crypto?
Well, that this is really a very, very good question. What I've seen in the past is that we need to build systems that are basically a closed loop. So what we wanted to do is make sure that some of the fees that are collected from borrowers can maybe go to incentivizing liquidity pools. We're still working on that, but yeah, it's a very interesting question, and I think it's all about escape velocity. If you like right now, we're definitely not in escape velocity. We've got very, very liquid, illiquid markets at the moment. We're brand new, so I don't recommend anybody go and take a 20 grand loan out because you just won't be able to basically sell it at this stage. Um, at this stage, we're on the launch pad, and we're asking people to come along and help the protocol build that liquidity out. And we're putting USDC down, we're putting ARB down. We just got an ARB grant. We've just joined the Chainlink build program. They took us on. They invested in us. So there's a bunch of things we can do to incentivize liquidity, but it's about I think people, once there's enough escape velocity, there's enough people that have taken loans out, there's enough people that have interest in keeping liquidity into the market. Plus, the DeFi is amazing. There's so many great protocols out there that will enable systems once they're big enough to self perpetuate almost if you build the right incentive structures, which are
Sure.
basically these rail guards that bounce around. Yeah. But
So
the important thing is to always stay over collateralized. That's the main thing.
for sure.
Programmatically.
So let's say I had my holdings, right? And I've already averaged in. I've been averaging into the market for the past 6 months, and I've got what I'm going to have, and I'm like, you know what? Not touching it until the peak of the market. And I want to take a chunk of that and add liquidity to this system. And maybe over time as this grows, let's say I had 2 Bitcoin and I want to add liquidity to the platform. Does the value of my liquidity in this system continue to rise with the price of Bitcoin, or am I basically saying I'm providing liquidity at Bitcoin's price point at that day? It doesn't go up because now it's another asset. So that if I wait and I'd say at the peak of the market, Bitcoin's $200,000, but I added liquidity at 40,000. Am I making that total gain, or am I like, oh shit, I should have waited?
Yeah, so there's 2 different ways that yield farmers profit. So in the DeFi space, if you add liquidity to a DEX, there's this thing called impermanent loss where you put 2 assets. Let's say you put Bitcoin and USDC into a pool, and everyone's just buys your Bitcoin off of you. Now you're holding just a whole bunch of USDC. Obviously, you're holding a whole bunch of USDC, and if Bitcoin skyrockets, you miss out on those gains. But what people do that yield farm, they're not in it for the gains of Bitcoin. They'll have some Bitcoin as that side of their strategy, but they'll hold 2 stable coins and allow people to trade between them, because there's hopefully no impermanent loss between 2 stablecoins because they're stable. So they're not going up or going down. How they make money is in the trading fees, because the DEX pay all the trading fees to those liquidity providers and the incentives that certain pools put on them. So we've got incentives on Camelot DEX in Grail, which is the native Camelot token. Camelot's the largest DEX on Arbitrum, which is the largest L2 in terms of the DeFi space on Ethereum. And Grail, when you own Grail, it gives you also a part of all trading fees paid into the DEX. So it's a really good token. And we also pay out in TST. And now we're also incentivizing one-sided liquidity that pay back in EURUSD as well. So there's a whole bunch of ways to earn money, even though you're holding two stable assets, or even one stable asset and staking that, you're earning, your yield is earning in stables and other volatile assets. So yeah, it's dependent on your strategy of using DeFi. Do you want to just hold Bitcoin? Well, just hold Bitcoin. It's a great strategy because look, it's it's worked for a lot of people. But if your strategy is to yield farm, meaning go out there and earn interest and a yield, then I would say hold two stable coins and put them, or one stable coin and put them as one-sided liquidity into a DEX.
So is it safer for me to assume that I'm better to wait until the peak of the market and then almost use this as an exit strategy rather than something that I do prior?
Oh man, I don't really want to give financial advice because everyone's different.
That's fair.
Everyone's in a different boat. Some people feel like if you're someone that's a lot older, you want to do less.
Let me rephrase this. Let me rephrase it to make it a little easier. So based off of what I'm hearing, I can either basically go in and add liquidity to the system now. But I would be doing that through stable tokens, which ultimately I would be losing. I think I would be gaining, the yields from the different asset farms and all of that. And that's all fine and dandy. And some people make a whole run out of doing exactly that. I don't have the time. Like a lot of people bounce from yield farm to yield farm and all, that's not my bag. But I am thinking to myself, this is just me personally. If the peak of the market hits in 2025 and Bitcoin's worth 200 grand, well, if I've got a few of those and I'm ready to exit into USD or something anyway, why wouldn't I then maybe just take one of those or take that couple hundred grand, put it into the liquidity pool, and then make a passive yield throughout the next bear market at the peak of Bitcoin's value, rather than do that today and then potentially miss that, $150,000 yield per Bitcoin by just holding it. So I'm just putting those thoughts out there for me personally and kind of what I'm thinking based off of what I'm hearing. But it sounds like a potential exit strategy for me.
Look, you're spot on. And I think this is where, depending on the market, you'll have different reasons for doing different things. So if the market is consolidating through time rather than through price, meaning it's just a boring market moving sideways, it's just like, man, nothing's happening. Why not put your money into two stables and start earning yields that basically mean you can buy more Bitcoin with it? Or even better, if the price is actually going down, if Bitcoin's going down, and you're holding stables, well, you're actually holding your value, plus you're earning a yield because the trading fees and everyone's freaking out and buying and selling and trying to find that market. And then as you stack those sats, it's working out for you. But you never know when that is, right? Are we going to get the news next week that BlackRock's ETF is totally dead and it's just again a carrot that's been dangled in front of all the crypto bros? Like, we never know, and everyone has different reasons for doing different strategies, and that's what makes the market so dynamic. But
I have another comment.
I'm just
Well, and I'm thinking to myself, if there's any crypto accountants out there in chat, and I'm just thinking out loud again, if I were, let's just say hypothetically, Bitcoin went to 200 grand, and at the peak of the market, I happened to luck out. I actually happened to call the peak and the double peak on the same day in the last market cycle, and everybody just was so mad at me because they thought that I was trying to. Yeah, exactly. I literally called the peak getting on the plane to Puerto Rico, and when we landed, I said, "But chill out, it's going to be a 2-peak cycle." It's all still there. And nobody was calling a 2-peak, but there's a whole other story to that. But I'm thinking if I were to nail the peak of this cycle, technically speaking, if I were exiting my Bitcoin position at the peak into not USD and I'm not cashing it out, I'm not putting it into my bank account, even though it's potentially a taxable event that would have to be logged for taxes, technically not paying those taxes until I've cashed them out and put them in my bank account. And this could be different wherever anybody is. This isn't financial advice. I'm not telling anybody what the tax laws are. I don't know. My accountant handles all that. I just know based off of what I've seen and the way things have worked for the last several years that you're not technically paying the taxes until you've cashed out into fiat. So potentially, and I'm curious for anybody out there, if I were to exit my Bitcoin position into either a stable coin position to add liquidity to a protocol like this, and I were going back and forth, would I ever have to pay taxes on that money? Not a question for you, but generally a question for anybody that knows, because to me, it sounds like, when do you pay the taxes on that if you're just basically cycling through the liquidity pool and the asset directly back and forth every market cycle, playing those swings?
Well, I don't know where everybody's living, obviously, and there's different tax codes for everybody. But if you generally how the rich work, how Elon
They borrow against their own assets.
They borrow against their own assets.
They don't pay taxes on it, which is kind of the point I'm getting at. I'm just trying to I like to play a little dumb sometimes, Joshua, let people figure shit out on their own.
Yeah. So, and that's one of the great strategies people have seen using the standard. The early, they don't want to sell, so they're locking it up. So if you were to go and take your ETH and put it on a DEX and buy USDC, that's a taxable event, because in certain geographical regions, if you're in Germany and you've held longer than a year, then that's not a taxable event. There's no capital gains tax after a year. But in the US, depending on your state, I don't know what's going on. A year.
In the US, the capital gains are, you pay the lowest capital gains tax after a year of holding, but that's also relevant to your income tax bracket. So there's a whole calculation there. It's, they try to get you any way they can here. I mean, and I saw the comment, my accountant wants to tax every transaction that shows sell. Every transaction is a taxable event. Like, it does trigger a taxable event, but when that tax is due is the question. It's technically, as I understand it, check with your financial advisor, your accountant. Don't listen to me. I'm just some old guy on the internet. I don't know shit, and I'm always right sometimes. My friendly little disclaimer, Josh. But it's technically not. There's a difference between a taxable event and when the taxes are due. And if you're it's no different than bot trading. If I'm trading Bitcoin to USD, or Bitcoin to Ethereum, back and forth, those are all taxable events. But those taxes aren't necessarily due until I've converted one of the key assets into fiat into my bank account, so that I have the actual funds to pay those taxes. If it stays in something that's not fiat, then, and I almost think that that's one of the reasons why, like, Janet Yellen and all those people were trying to push for an unrealized capital gains tax, because they want people paying on the unrealized taxable situations, not the realized gains, which would just completely ruin the country. But I don't think any of these people care that much about that.
No. And so basically with the standard, you're not selling, you are sending. It's like if you sent your Ethereum from one ledger wallet to a different to your other ledger wallet.
Right.
It's not a taxable event because you're not selling anything. Specifically, the standard is basically another wallet of yours. Your private key controls that private key. So you have control over that wallet. You're uploading your crypto into a wallet that you control, and then you're minting brand new stable coins at a debt. So you have to pay that back at some stage, and that's why it's not a taxable event. Generally speaking, I don't know where you're living, and I don't know the ins and outs of your tax.
No, I think you got it right. Even in the States, I think that's kind of how it is. They got to have loopholes for the billionaires. taxes are ultimately for people that can't afford the smarter people to do their taxes for them. I've had 6-figure tax bills the last 2 bull markets. So, I mean, I definitely pay taxes. It's not like I'm always trying to figure out ways around it. But when I don't even mind paying taxes to some degree as long as it's fair, and it's just like, if there's, like you said, the wealthy live off of borrowing against the assets they've already accrued, so that they're not constantly paying taxes on the same money over and over and over again, ultimately, because it's in effect what kind of happens if you're not smart with it, which is how wealth never lasts, especially like the difference between new money and old money. Old money knows how to benefit from the money they have. New money ends up blowing it all. It's like you hear all the people that win the lottery and then they're broke 3 years later. It's because they go out and they spend it all instead of putting that money to work for themselves, when they should be borrowing against it, establishing a lifestyle within those confines. And that's just never really the case, So this sounds, Josh, honestly, this sounds like a really solid system. And I'm very much interested in figuring out more in different ways that I can get involved with this myself, because this is the kind of thing that honestly I probably would use at the peak of the next market, and just rinse and repeat, cycle to cycle, man. One quick question though: what sort of smart contract audits have you guys done for a lot of this? Like, who do we know who's done the audits? How many have you had? How many different smart contracts do you have filtering through this thing that could, what's the security of this kind of system like right now?
Yeah. Well, interestingly, we just had a breach a week ago or 2 weeks ago.
Okay.
And
that's new.
And it was stressy, man. It was really stressy. But the good thing is, it really it's super early, so it wasn't massive. But it wasn't to do with the code. No one cracked. Everyone's money was safe because they control their private keys, as safe as a ledger. The thing is that someone gamed the way that we architected some game theory stuff. So, for instance, basically what happened, we opened up trading your collateral, so you can lock up assets and trade it to Pax Gold, like I mentioned. So what happened was that Pax Gold, there was no trading pair on Pax. Well, there was a tiny little trading pair on Uniswap, on Arbitrum, between Pax Gold and Bitcoin. So what the attacker did is they went and created a new pool between Bitcoin and Pax Gold on Arbitrum, Uniswap, and made Pax Gold really, really cheap. Basically, really expensive, sorry. 10 Bitcoin for a gram of gold, right? Because they controlled that pool. They then went and put 10 Bitcoin into the standard, borrowed EURUS against it, and then dumped that on the market, and then traded all of their 10 Bitcoin to Pax Gold. So in that trade, they basically, that was a way to get the 10 Bitcoin out of the smart contract into their liquidity pool on the DEX and receive 1 gram of gold. So it was a very sneaky way. We went into like crazy mode, where I got to say, the DeFi community on Arbitrum jumped on a call with us. Chainlink jumped on a call with us. Gamma Protocol, the largest DEX in the space, jumped on a call with us, all to figure out how to quickly react. And we ended up appealing to the white hat in the black hat. A white hat is a good hacker, and a black hat is a bad hacker, right? And usually black hat hackers actually come from a white hat background.
Right. They get bored.
Except they get bored, but they sometimes also get screwed over. Like they'll find a vulnerability that they can take like $10 million, and then the protocol goes, "Oh, here, have a, I don't know, like
here's a cookie,
Starbucks,
thanks.
Starbucks gift voucher,
Right.
And then they just get peed off with that. And next time I'm going to just take the money. And so what we did is we appealed to the white hat by writing him an on-chain message locked into the address that he used, or she, into that. And the next day, the funds, 80% of the funds were returned.
Oh wow!
But Yeah. So
they kept the fee, but at least they came back with it.
Exactly. And that was the offer. We said, look, return it. Thanks for showing us that this was a thing, and you can keep 20% for that, or you can keep it and you have to be looking over your shoulder for the rest of your life. I mean, it wasn't even.
I will find you.
We will find it. Because blockchain analysis is pretty good these days. You can follow every stat. So there, it was what really happened there was amazing, because it allowed us to be really transparent in what was happening. And running a centralized exchange like Voltoro since 2014 was totally different. We had to be absolutely closed source, really focused on secrecy to know what, to keep it safe, because Voltoro had never had a hack in that whole time of running. And it's not through the lack of people trying. Like any centralized exchange, it's a honeypot. Because it's holding a lot of crypto. So being decentralized, it was a really big game changer to be as open as possible with the community about what's going on. Now that this is happening, hey, here are the funds. And everyone worked together to try to solve this. So it was really good. So we've patched that. So what I'm saying is that DeFi isn't some panacea away from risk. It's still risky.
For sure.
But where there's risk, there's great reward. Being part of a really early protocol and helping us add liquidity and stuff could potentially yield some really good rewards. It doesn't have to be the case. There could also be a lot of losses. We're a brand new protocol. This is all an experiment. Don't invest anything that you can't afford to lose. Please don't. Be safe out there. Slowly,
speaking of the risk, James Sachs made a really good point and a good question. We've talked about it a little bit. We've touched on it, and I won't keep you forever, but I definitely want to make sure that we've explained this appropriately, because this is live right now on YouTube and Twitter, and I'm sure it's going to grow. I think this is probably going to catch on to people that are really interested over time here. The liquidity side of things and margin calls, like basically covering the difference in when you enter and the potential losses if the market changes direction, right? And some people, you obviously have like two options. You could go in, you can mint the stable coin, or you could basically maintain your position in whatever asset you're putting up to borrow against. And if the value of the asset you're putting up to borrow against drops, well, depending on how far that drops, you could be you could need to make a margin call, in essence, where you're covering the difference to maintain your position for your collateralized ratio, right? So explain a little bit in detail how that works so that people understands like how the risk does work. If you take out a loan against your own assets and you're at 110% collateral and the price drops 15%, now you've got to make up that difference based from what you've put up, right? So explain that a bit.
Yeah. Okay. So there's a couple of things here. If you've taken out a loan, you're posting a bunch of collateral, because in the DeFi space, we don't know, like the traditional world works on your credit rating. So that's what gets hit. Your credit rating. If you could take out a loan and then you don't pay it off and you get a black mark, so you can't go to the phone store and get new credit because they check, oh look, you don't pay off your debt. So DeFi is different because we can't do credit checks. We don't know anything about that stuff. It's all programmatic. So you have to post more value than you're borrowing, and this happens in traditional financial markets as well. But if you've locked up 1,000. You can borrow up to 900. As soon as you cross that 900, that 1,000 just gets liquidated. It gets sold to somebody else, because the system there always needs to be more collateral locked up in the system than there are stablecoins. There always needs to be more value than there are value in stablecoins. This is what keeps the stablecoin stable, because there's more value locked up. So as people, if you lock up $1,000 worth of crypto and you borrow 900, or you borrow 850, let's say, now crypto starts to tank in price. That now that value starts to reach that 110% collateral, what happens when that crosses the line? You're basically, there's a pool of EURUS sitting there ready to buy up your assets at 10% under value. So basically what that means is they pay off your debt of the 900 and get $1,000 worth of assets dropped onto them in that moment. So they get they do that by buying it, and that debt, those EURUS then get burned. So when those get burnt, now you're removing EURUS from the system and removing collateral. So that's how a liquidation works. That's how a margin call works, is that basically it's programmatic. There's no people involved. We cannot have a system with people because people will corrupt it. There's always someone looking to make money. This is the amazing thing: people versus robots. You have to build systems that are regulated by mathematics rather than regulated by people. And so these margin calls are programmatic. We are looking at ways that we can notify people that they're getting close. This is tricky because it builds a centralized factor into so it can't be protocol based, but it can be the front end. So we're allowing people to build front ends, so anybody can build a front end to our smart contracts. So like I said, we don't control these things. These are smart contracts that we've released and people can use them. They can send ETH in and out. But the front end that we built is like a reference client. So we can have we can maybe put in like browser notifications. Hey, your vault, by the way, is like getting close to 110% collateral. So you have three options. You can either, if you get close to 110% collateral, like the market's just crashing, you can either go off and pay off your debt. So you now have 600 or 500 owing. Now you've got 150% collateral ratio because you've got way more collateral than debt because you've paid down your debt. So now you're safe. That debt can get down, can keep going down in value. That's one thing. Or you can add more collateral. You could say, I'm going to add more collateral. That will do the same thing. It'll move you away from that liquidation price. So you can either pay off your debt or you can add more collateral. Either way, those two things separate out. And the third way is, like we mentioned, is trading your locked collateral to something that's more stable. So it just stops the bleed.
Right.
And that's what we've really focused on. Or you can sell your entire position as an NFT on OpenSea. If you're like, man, I can't deal with this. I've just got to sell it because I've lost my job. I can't afford to add more liquidity or whatever.
I see the potential for this kind of system, and Shamanic had made a comment in comparing it to like pulse chain stuff, I guess. And I'm not a pulse chain guy, but like liquidity on Ethereum, collateralized loan protocols, all that. Yeah, I mean it's exactly what this is. And I'm listening and I'm seeing the potential for how this can be utilized to basically take whatever assets you have, and based off of the timing of the markets and when you do what, you could ultimately end up in a perpetual cycle of gain. Really, I mean, you do X in the down market, you do this in the up market, and and the back and forth, and ultimately you get to a point where you're just accumulating on through the cycles, and just I really like. I've always been weary of DeFi protocol stuff. I've never done anything really with it. I've dabbled here and there. I've played with it. I'm always so weary personally. Like even when I was extremely bullish on Celsius, and obviously that's a completely different system. I mean, there's no comparison between this and Celsius. It's obvious.
Well, this is like an answer to Celsius. Yeah,
exactly.
It was like, man, so we've got to build a better system than this crap because everyone is just getting rorted here with these centralized things. Why we build the most amazing, epic parade called decentralization and then rain on that parade with nonsense like Celsius and FTX?
Greed.
Like, what are we doing here? Why are we going back to centralization? Greed and ease of use, I think.
Right. Well, you're right. it is a lot easier for somebody to send their collateral to, some other thing, a person, and say, here's my collateral. Okay, here's the address I send it to. And it's very kind of easy, cut and dry, but you're empowering that other people with your assets. And yeah, this basically takes just like the whole nature of Bitcoin itself. It's a trustless system, obviously it's a result of the technology it's built on. So, but I am definitely, I've got my eyes on this, Josh, and I really appreciate your time in explaining everything and kind of opening my eyes a little bit more to what basically a trustless system for ultimately, I would love to I wish I could have you and Alex argue, and just kind of fight out your ideals, right? And like explain, Alex, how is this supposed to help people? And then you can explain, how is this supposed to help people? Man,
if you want to host the debate, I'm totally willing to come on. Like I'm not shy.
I don't know if they'll let him have microphones in prison. I don't know. I'd have to call. I'm assuming he's still locked up. I haven't heard he got out. I could be wrong. He might not be. But
maybe we can pit him and FTX. What's his name?
Sam Bankman-Fried. Yeah, maybe they can have a debate
together. Yeah. No, look, this is really, really important. And again, I just want to reiterate, we are very, very new. This is all an experiment. Don't gamble the farm. Be really careful in this space. These things. Look, you might not. We're definitely not trying to do anything nefarious, but we are an experimental thing. DeFi in general is experimental. We're on Arbitrum, which has still got a centralized factor to it, even though it's an L2 and it chains down to Ethereum. There's something there, like it's not been tried and tested like Bitcoin has. So if you're super fresh to this and you're just stacking sats, you don't have, you're working your ass off to stack sats and you don't have much between that margin of, don't do any DeFi stuff. Just stack sats because that's going to do the best for you. If you have a bunch of money that you can deploy and risk, because where there's risk, there's also really good reward, but there's also a lot of risk, right? You could lose it. So just be careful. And in terms of the auditing, by the way, I just want to reiterate that we're talking with the best auditor in the world. They used to be part of Chainlink, and we're going to do a competitive audit, which means that thousands of people basically try and penetrate and test us now. It's an expensive procedure, but it's definitely.
Can I throw my hat in the ring? Can I try and hack your system?
Yeah, let's go for it. Absolutely.
I'll get my Linux box ready, and we'll see if I can do some damage.
Nice. Yeah, it's important, And actually, we had a really good meeting with Chainlink the other night, and we were trying to come up with solutions because it's the early protocols that don't have much money can't afford these really big auditing, because these auditing firms, they cost like 60 grand a week, some even, to really do anything.
Better than 60 million next month.
Yeah, exactly right. So the big protocols that have a lot of TVL, can afford things. It's the smaller ones that can't. So we're trying to work together with Chainlink to say, hey, all of us small startups should work together to audit each other, because we all have different perspectives on things. We've all got skill sets. We don't all have millions to throw at auditors, but let's audit each other's code and look over each other. So we're working with Chainlink right now to do that. Chainlink's been absolutely amazing being part of their build program, which is kind of an accelerator program that they invest into really select projects like ours.
Really? So they've been a real good, like, kind of behind the scenes partner in supporting you.
Yeah, they've been absolutely sensational.
That makes me want to go buy some. You really kind of nailed the ideal on the head, really, because there's so much tribalism in crypto, and there's so much, our camp is the best, our camp's going to make us the most money, our camp is better, or we have better people, or we have better tech. And it's like, and I'm guilty of it too, because I'm a big Solana guy, or a Cardano guy, and I'm always talking trash about Solana, right? Because to me, the nature of Solana just rubs me the wrong way. It's all the whales, it's all the VCs. They put in their money, they play the market, they buy a lot of paid advertising with a different. It's like, it just feels kind of like dirty to me in so many ways. And then but at the same time, it's pumping like crazy. It's going to make people a lot of money. So it is what it is. You pick your poison.
Yeah.
But I do wish that, and I know, and I always say, you have to be the change you want to see. And I feel like I have to really start. I want to see more crypto projects working together, man, instead of working against one another. And it can be very difficult at times when you see certain things that really kind of piss you off, and you just want to get out there and scream about it. But I would love to see more crypto projects kind of working together, pooling their funds, establishing lawyers really for fighting these legal battles that are basically being thrown around all over the place. I would love to see a group of large crypto companies working together to try and help force regulatory framework, lobbying, which I know that there's some of that. But just a lot of the different vehicles that are in play that can either work against crypto or for crypto. It just depends on who's going to come together and really start sharing the mission. And so that actually makes me feel good. I like that Chainlink has been working with you. When is the Cardano integration?
Well, it's a really good question, because Cardano, it doesn't really have. They've just, I think, in the next week will launch their first sort of stablecoin project. So I'm definitely keeping an eye on it. We have got it on the roadmap. We do want to become the standard in stablecoins. The name isn't just some label. It's a goal, and so by by that we mean we want to be on every major chain and enable people to lock up assets. And not only that, we've been working in the back end to again with Chainlink to develop systems where you can lock up assets on one chain but mint on another chain while holding the private keys off both chains. So no one has any interaction apart from you. So this is all interesting stuff. It needs oracles. It needs some of the stuff that Chainlink's building, particularly CCIP, which is this great protocol from Chainlink for cross-chain integration. But yeah, it's on the map. It's just we need to focus on one chain first, so we build liquidity, because if we're on multiple chains, then that liquidity gets even thinner.
Right.
But if you are interested in supplying liquidity, head over to our website, have a look at the Camelot DEX. That's where we've got EuroS and with USDC.E, which is bridged USDC, and go and play some liquidity in there if that's the sort of thing that floats your boat. And there's great rewards. And then you can head over to Merkle. And this is actually, Jason, what you were talking about before. When I moved from Bitcoin and started working in the Ethereum space, like you said, Bitcoin is so full of tribalism with Bitcoin Cash and Bitcoin this and Bitcoin SV, and everyone's just so angry at each other. I gotta jump out. I don't do enough work on the website, I gotta say. I gotta fix some of these things. But I just had a meeting with Angle Money, who's also got a Euro stablecoin, and they were totally willing to help us out, and actually brought us onto Merkle, which is a way to have one-sided liquidity and get rewarded for it. So, by the way, we've got Patrick Friedman on our, who's the grandson of Milton Friedman, on the advisory board. We've got some really great advisors. Hartesh Sawhney from he's pretty much the grandfather of smart contract auditing. So we've got really great people in the back end giving us advice as well, which is phenomenal. But it's definitely an interesting time to be alive, that's for sure. And as we move away from centralized things like Celsius more to self-custodial debt, I think it's probably the most interesting. And add to that AI. What's happening in AI and stuff. We're living in the most interesting time, and I'm really glad to be witnessing
I'm very
it.
much excited about it. I'm very much excited about this new market cycle, and I've got my eye on everything that's going on leading into the halving, and I want to see kind of what starts really popping off once we get closer to the halving, the date of the halving, because I think that there's still some questions as to what's going to happen between now and the actual halving. So I've got my eye open, but man, once we get there, it's off to the races from there. Josh, I've got dinner with my wife scheduled, and I know you're up at the butt crack of dawn to be here, so I really appreciate you, man. And
Jason,
don't be a stranger. Okay. Keep me posted on anything Cardano related 100%. And anytime there's a big update or something, man, just send it on over to me, and I'm sure I'll throw it in my coverage for the day. Like, I'm more than happy to do that. And don't be a stranger. Hit me up anytime you have any questions or anything at all. I'm always available on Telegram.
Thank you very much, Jason. Really, really appreciate it.
For those of you guys watching, thanks for joining us for the interview. Hopefully you guys had fun on Twitter, because I just recently started streaming live on Twitter as well, because I'm loving it. Oftentimes I see 150 people here, and I'm seeing 400 or 500 people on Twitter. It's crazy. And make sure you check out the standard.io. Make sure you follow all the socials, grab the white paper, read it down over some coffee in the morning, and have some fun. I've got my eye on it. Josh, thank you. For the rest of you guys, crow your coins, and we'll see you again very soon.
Cheers.